Did you know that people are shown to take more risks at the end of a week or the end of the month or the end of a year? It's true. There's research that proves it. And so you have to think about whether or not you are unwittingly taking on more risk in your portfolio. We'll be talking about that this week. Stay tuned. Make Better Wealth Decisions, a podcast that explores how financial advisors' blind spots can harm your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. In this podcast, we'll provide advice on how you can achieve better outcomes by maximizing investments and minimizing taxes. Let's put our thinking caps on as we consciously decide to get smarter about our money. This week, we're speaking with Dr. Avni Shah, who is an associate professor of marketing at the Department of Management at the University of Toronto, BEAR, the Behavioral Economics at Rotman. And you're also involved, Avni, with the Creative Destruction Lab. What is that?
Yeah, it's an awesome incubator program, and it's a accelerated program for deep tech like science innovations, and helps to massively scale them and commercialize science.
Excellent. So we love talking to people who actually find ways to make behavioral economics real. And you've done some fascinating research with regard to taking risk on temporal end dates. And we're going to get to that in a minute. But before we get to the meat of the presentation, I was wondering if I could ask you to please be so kind as to offer a very quick primer on Herbert Simon decision making, bounded rationality, that sort of thing, because those are the sorts of concepts that people like you, it's like mother's milk, it's just normal. But bounded rationality and making mostly okay decisions is the sort of thing that a lot of people listening to this podcast might not have ever heard of before.
So I'm going to keep it really simple because I'm going to direct folks to Herb Simon's 1955 bounded rationality work if you're quite interested, because really he does a great job, and it's incredible. But to put it simply, way back when we were thinking about economics, and I'm going to oversimplify things just for the sake of this chat, but we were thinking back with economics, okay, when people are making fully rational, fully informed decisions. So we'll make a decision making model, we'll do a theoretical model that's based on the fact that people are making these fully informed, fully explored, fully rational decisions. And one of the things that Herb Simon said was basically, well, that is good in theory, but people are bounded, right? And people have constraints. They have information processing constraints. They have all sorts of different types of constraints that lead to not being that fully informed, fully rational being. And it's basically saying that we have constraints on the way that we process information. We have constraints on the way that we are fully informed. And that led to really a whole host of research that now we can think of as behavioral economics, judgment and decision making, and really influenced many fields of thought across the board. It was really neat.
So the idea is that people satisfice. They make a decision. They say they want to consider all the options. They want to do it carefully and thoroughly. But in the end, what they do is they have an idea in their mind of what they want. And let's say you want to buy a car. You've got 3 or 4 or 5 cars that you're thinking of buying. And you test drive one or two, and you find one that you like, and you say, "Yeah, that's it. That's enough. I'll buy that one." And unless you're really detail oriented, chances are when you find one that's good enough, you might just proceed without continuing with the entire due diligence process.
I think that's a nice simplistic way of putting it, is
Sure.
basically we have to use this particular methodology because we have a constraint where we can't go through everything and we can't go through all of the particular options. And so we use these shortcuts in different ways. And satisficing, as you're mentioning, is one of the ones that Herb Simon talked about as being an efficient way to do things, right?
Perfect. So let's now talk about this little thing that you and your colleagues have unearthed, and that is that people seem to be inclined to take a little more risk at the end of a certain time frame. It might be the Friday afternoon, it might be the 30th or the 31st of the month, it might be year end, it might be before a long weekend. But at any rate, your research seems to show that people, for whatever reason, are more inclined to take more risk at the end of something, sort of like, I've been on a diet all week. I've been a good boy or I've been a good girl. By golly, I deserve a donut on Friday afternoon, or I deserve a glass of wine. Maybe you could explain it.
Yeah. So we study financial risk taking in our particular case. And so I worked on this with my collaborator, Shinlong Lee, and he was a PhD student at the time we started the project. And one thing that we noticed is that we were hanging out in the at school and we were so pumped, just like everybody else, pumped it's a Friday. Now, if you're in academia, if you're a PhD student, one of the things that's pretty interesting, maybe pretty exciting for us, is just that really work doesn't stop. Fridays are not the typical Fridays that they might have been in school where you get this break, but we were coming back to the office. I saw him the next day after that. But there was some notion that, oh yeah, we're at the end of the work week. This is an exciting time. Oh man, isn't it fun? And one of the things that got us to thinking about was, okay, that kind of feeling, that Friday feeling, for example, that end of the work week, despite the fact that many of us are going to continue on to do whatever it is, or even that, as you mentioned, John, the last day of the month, right? Which can fall on a Tuesday, a Friday, any which day. What is that feeling, that last feeling, even though ourselves are the same? And this is all really socially constructed, this notion of time and the notion of the end of a month, the notion of the end of a week, it's a construction. But couldn't that change the way that we options, make choices, and then in our case, take whether people take financial or more or less likely to take financial risk. And the neat thing that we were able to look at is we started off in this domain, then we did a bunch of follow up lab experiments to really get at that
Okay.
mechanism and try to really understand what was going on there. But we had data from Prosper, which is the largest peer to peer loan site in the US. And what that allowed us to do is basically for many people, they're making several bids, right? So they can bid on another person's loan. So this Prosper is a really interesting setting because for many people, like the bank could take a little while to process a loan. Credit cards have higher interest rates. And so this is like a peer to peer site where I put up and request money anywhere between 2,500 all the way up to 25,000, and I can say, hey, I'd like some money. And a lot of these folks have very good credit. So if you're another peer in this case, don't have to be friends, but just a regular person, you can go on there and say, hey, look, instead of investing in stocks that's like nameless, I'm going to go help fund Avni's quest for whatever it is that she's asked for. Maybe it's home improvement, maybe it's for education. And then I have to pay this back over the course of usually about 3 years, right? Now, each person comes with a particular risk parameter. So I could have a little bit more risky. I might be more risky for an investment than maybe you, John. And so as a result, there's a higher interest rate posted. Now, the higher their interest rate, the more likely they're going to default. So we can use this as a proxy because somebody else, like a different person, this person that's going to be investing, can then say, hey, I want to invest in this particular loan versus that one. But if they're investing, are they going to be investing in riskier options on a Friday than they would relative to the rest of the week, even amongst themselves as an individual, as a person? So it's not just, oh, maybe people who are more prone to risk taking come up on Fridays, but it's relative to you as a person on other days of the week.
Okay, so I just want to make sure that I'm following along. If someone is a higher risk, then you might have to charge them 8% versus a person who is a better risk, you only charge them 6. And so the person who's lending the money, would you say they are letting their guard down and just not paying attention? Or are they risk seeking and actually saying, no, I want to get an extra 2% over the next 3 years by lending John this money at 8% as opposed to Abney at 6?
Yes, that's a great question. That was something we were interested in. Is like, well, okay, so this is where lab experiments really help out. You can say, do they remember the same information? Is it a situation where I'm remembering a bit more of those negative details, right? The negative attributes of something more so on a weekday rather than earlier in the week, right? So like Monday through Thursday rather than that Friday. And we found really no difference. Maybe that could be going on a little bit, right? So we're not always perfect with some of these experiments, but I think what's more so happening, and then we ended up finding out through a series of surveys as well as follow-up experiments, is a simple question that we asked, which was, what day do you feel the most optimistic? And people, by and large, it was about like 40% of our sample, whenever we did different surveys, framed it differently in different cases. And even when we included weekends, like it was about 40, between like 38 to 42% of folks said, I feel the most optimistic on Friday. And so if you're feeling optimistic, then you could think to yourself,
Yep.
hey, maybe
Mhm.
exactly what you were saying earlier, John, that, hey, maybe then this is actually going to work out, right? Maybe this is going to really work out. And as a result, I'm going to go for this one that's going to prove promising. And I'm going to get more money on this one because why not?
So is it a carrot or a stick is what I'm asking. Maybe you don't definitively know, but are they actively seeking an extra 2% higher return? Or are they simply letting their guard down and not worrying about the extra risk associated with that higher expected return?
Yeah, I would say that they're optimistic. And so it's not,
It's the carrot.
it's really that carrot. That's not that they're letting the guard down. So it's just, okay, I'm optimistic that things will work out in the future. And really, what we're saying is that at that end of the week, work week, at the end of the month, at the end of the year, people were feeling more optimistic than earlier days in that period that we're comparing.
So there are some people who are well known. I don't know if you know who Annie Duke is, but she's written a book called Thinking in Bets and two or three other books since then that are very useful. And she compares financial decision making to playing poker because she was formerly on the World Poker Tour. And one of the things that Annie says is it's important to get immediate feedback. And there's no real immediate feedback because you're making a loan that's got a 3-year window. So the person could default at any point between when you make the loan and the 3 years later when the final loan is paid off. Do people learn? Which is to say, let's say you make a loan and you do it 2 or 3 times and the people keep on defaulting after 3 or 4 or 5 months. Do people say, "Hey, maybe I shouldn't be trying to loan people money at 8 or 9%. Maybe I should just lend money at 5.5 and accept a lower rate of return, but at least I don't have to worry about the person defaulting."
Yes, I'm going to actually separate you had a lot in there, and there's two
Okay.
really good points in there. Okay. One thing that we find here is that if you have more experience on that platform, in this particular case, if you're going through this experience many more times, then while you do show a bit of the effect, it's definitely muted. So there's evidence of learning, absolutely. But to your point, it takes quite a bit of time to learn this particular to get any consequence because it takes at least a few months to have a failure of payment before you even default. But we are seeing that people do in fact learn, right? And experience really moderates a bit of this effect, though we do see it a little bit. But let's contrast that a little bit with the immediate feedback. So one of the neat things in the literature that I've been shown is like a lot of times they'd seen people take greater risk at the end of a series of bets or at the end of a series of gambles or a couple of the cool papers in the space at the end of like the last race of a day when you're going to the
Right.
horse race. Yeah, you're betting on horses there. And so the explanation in a couple of those cases was one, you saw a little bit more in the early times when people are trying to basically break even. So you saw that particularly when people were on a losing streak, they're trying to bet so that they might make balance all those losses and actually finish at least at zero or even better. But they even found this regardless of whether they had to catch up or not. So even if they were in the red here or in the black, they found that people actually did that last race. It was like that emotional reward here. But a lot of that was thought to be immediate feedback. But what we're seeing here is that there actually might be things and elements that are really socially constructed regardless of that feedback. So that you could still be having this emotional or in this kind of motivational, right? In our case, the optimism, the motivational response that actually influences people's choice, regardless of whether they're getting that feedback. And so while experience does lessen this effect and attenuate this effect, it's not the full thing because we still are prone to this. It's the same reason why on Fridays at work, where it's like, oh yeah, it's Friday, despite the fact that I might be showing up or even teaching on a Saturday. Um, yeah, it's pretty neat.
Okay, so I wrote a book. It's over there over my shoulder there called Bullshift. It's about how the industry shifts your attention to make you feel bullish. And the subtitle is How Optimism Bias Threatens Your Finances. And so we have that in common. We write about optimism. I'm
Yeah.
wondering if you could offer your thoughts about optimism being time bound. Are you suggesting that this is the sort of thing that it comes and goes? Or is it the sort of thing that Dan Ariely would say it's predictably irrational, that we consistently do it whenever we're in this situation more, or at least consistently more often than not, and we can reliably expect that if it's the last horse in the last race in a day at the racetrack, that maybe betting on the 30 to 1 shot as opposed to the 3 to 1 shot.
So what I think is really going on here is that first of all, we'll step back and say that people have these associations with these temporal brackets, right? And so there's an units of time, right? There's days, there's weeks, there's months, there's years, so on and so forth. And so as a result, there's all sorts of neat research in in temporal bracketing and mental accounting. It shows that basically we act differently throughout this period, and even how we manage money, even how we balance our books. We use this time as a cue for how to process information within and evaluate choices within that particular block of time. And so I think that's a bit of what's going on. And that's what we're seeing here is that basically at the end of, again, the socially constructed landmark, you could have a feeling that, okay, I'm ending one period and I'm about to turn over a new leaf, if you will. And we know that there's other research on this as well, this fresh start effect, that people
Mhm.
are much more likely to start those diets, right?
Join the
January
gym in
1st,
January. Yep.
right? Absolutely. And I know for me, I think of it the same way. At the first of I'm like, oh, the month, 1 month is ending, a new month. Okay, here I have all these goals. And at least I'll talk about my own self. Every time that I'm ending 1 month and turning over to a new month, I'm sitting there and saying, "Oh my goodness, okay, I'm gonna submit all these papers. I'm gonna do all this other things. I'm always incredibly optimistic about what I'm gonna accomplish. And then I get realistic over time until right around the end, then I start to repeat it myself again. But it's one of the fun facets of life too, is that
Right.
the way that we think about time, the way that we interact with our environment is largely socially constructed. But it's a good thing too, right? It gives us also sense of purpose as well.
It does, and it's funny how you talk about social constructs because everyone knows that risk and return are related. That's not particularly new. You want to get a higher return, but you've got to take more risk. What people don't think about are these intertemporal differences and how that might have an impact. Because again, if you ask most people, I wonder if there was any, and I don't think that was this. I don't think I saw this in the research. But if you go back and you talk to the people and say, "So did you realize you were taking more risk on the Friday afternoon? Was that a conscious decision, or was that something that just happened and you only sussed it out when you went through the numbers?"
Yeah, no, that's a great question. So I didn't have a situation where I was able to talk to the specific investors, but I bet people would say, hey, many people might not remember because we're not talking about huge differences here. We're not talking about the difference. People on average make 3 to 5 bids per week, those active users at that given time. And they might have 3 to 5. And so they might not remember, and it might not be huge. It might not be a difference between 5% and let's say 30%. So it might not even have that stark consciousness, but it's that general trend that it's like you are more likely to have a higher to like basically 5, 7%, likely depending on the model, but around 7 though. But if somebody were to remember and be so conscious, they might not be able to say something as similar as, "Hey, on Friday or at that last day of the month, I knew that I was optimistic, and then I knew I was turning over this new leaf, and why not?" They might not, but at the same time, there's some awareness. That's what I was really surprised about, is that there's some awareness that people do feel more optimistic on these days. They look forward for many people, Friday is their favorite day for a reason, or the last day of the month, they feel more optimistic. And so I think there is some conscious awareness that we do have different states, that we do feel differently. And the market or financial risk taking can also basically match these particular things. I will say, you probably know this, John, but you even see calendar effects, at least at the level of the market activity. So I'm not even talking about a specific person, but the market, that basically there are a lot more activity right at the end and the beginning of a month than there are during, particularly in comparison to like the rest of the month, right?
If it's any consolation, I'll share something that I've found, and
Yeah.
I've written about a number of times, and that is it's not so much intertemporal, it's more of a systemic concern, is that I think people are too optimistic in general. So people like FP Canada, the people that confer the CFP designation, put out annual assumptions guidelines for the rates of return people should be expecting. And those assumptions guidelines usually come in the neighborhood of 3 or 4% for bonds and 6 or 7% for stocks. You build a balanced portfolio, it comes in maybe a little over 5, but that's before costs come in. And then you're paying, if you're using an advisor, you're paying the
Right.
advisor
Fees.
1%. Even if you're buying mutual funds, or even if you're buying low cost products, low cost ETFs, you're still probably paying another 25 or 30 basis points there. So now you're paying 1.25%, and your expected return before fees was 5.25. So now your expected return, if you do it properly, is 4%. And that's what a reputable planner would say, is that a balanced portfolio, you should be expecting a return of something like 4% after you pay everything. Virtually no one I know in the industry, and certainly the people that are retail clients that come to talk to people who offer financial advice, have that kind of a return expectation. They think a balanced portfolio can get them 6 or 7 or more. And I'm going, you just can't do that. And it's not realistic. And it's bad for business. The point that I make with regard to bullshit, shifting
Yeah.
people's attention to make them feel bullish. A lot of people, if you tell them the truth and say you should only be expecting 4%, will say, that's nice. I'm going to go work with someone else who's going to tell me I should be getting 6 or 7, even
Right.
though the four number is actually a much more reputable and evidence based.
Yeah, I will say this though, right? That I fully agree with you, right? What you're describing is two things, not just the optimism, but the inattention to actual costs. That people forget that what they've made is not just simply like revenue is does not equal profit, basically, is what's going on. You need to really factor in the cost. And so that inattention is a huge issue for sure. But I will say that there are numerous folks in various settings that because risk inherently isn't bad per se. And there are some folks that actually can benefit from a little bit more risk. I love to give this example. My mom, my dad, very different folks in terms of their risk propensity. But my mom is like, well, oh, I'll just go to this, put my money in this bank account, this like savings account that has like 0.02%, and we'll go from there, right? Because
'Cause
she's
it's
quite, like,
safe.
that's right, correct, right? She's incredibly risk averse. And so something like increasing optimism and having just at least some push towards a little bit more risk and a little bit more risk propensity could be beneficial in that circumstance. Now, in the circumstance you're describing, if folks are inattentive to all these costs, maybe they're even inattentive to even the downside of any investment, then yeah, then you want to make sure then you can't just think about the potential reward, but really what's the trade-off going to be? And is that a really prudent decision to make? So I think by and large, this is like an interesting, we all know of different outcomes, but we like risk itself is not necessarily bad, though at
Right.
times people can do, unfortunately, risky and then downstream negative consequences that are associated with that risky behavior.
There are dozens of
Yeah.
things that have been unearthed in terms of heuristics and biases that we pretty much all have. What you've uncovered right now could be called any of a number of things. It could be called mental accounting. It could be called overconfidence. What would you call it?
I would say it's really simply like a optimism bias, right? There's a few
Okay.
folks that have worked in this space too. There's a really neat book by Tali Shiro called, I think it's actually called The Optimism Bias. And I think that it doesn't have to lead to bad decision making. In fact, optimists are generally healthier in many ways. They'll go for more, they'll apply for more jobs. You need to have that confidence a bit. But I think it's more of a bias. And then you've got this like heuristic, this cue of the week itself, or the end of a period that leads to then a potential for this kind of optimism bias and risk taking accordingly.
Daniel Kahneman, who's the granddaddy of all of the
Yeah.
behavioral economists, has said that if he could imbue a newborn child with any one attribute, it would be for optimism or joy, because optimism
Yeah.
correlates positively to positive life outcomes most of the time. So again, I have to be careful because when I chose to write about the risks of optimism bias, people thought, well, that's the good bias. What are you talking about? You can't be negative about that. But the thing about optimism bias is that people they don't. It's not they don't think bad things will happen. They don't think the bad things will happen to them. So the sense that I'm getting at is that listening to you speak is that people will know that a certain percentage of people who make these loans will have those loans default, and there will be a problem. They just don't think it's going to be their loan
That's
that
right.
they're lending, that they're funding, that will
That's
be in
right.
default. And it's like, what makes you so special, right?
Right. I mean, the chances are that if something is higher interest or it is riskier and it is more likely to default. But yeah, absolutely. It's like, oh, it's not going to happen to me. And in fact, I'm going to be the case where I'm going to really get a benefit from this high interest rate and this reward. It's all going to work out. And you're right. There's so many health benefits in terms of like mentally, physically, emotionally, certainly, and even just a plethora of outcomes that are really positive, but it could be a detriment. And it's always important, right, to understand when is it a detriment, when is it kind of bleed over to the detrimental, and just having an awareness of that.
So I want to end with the question that I always ask, and that is, this is a podcast about helping people make better wealth decisions. So knowing what you know, what advice would you give people to help them make better wealth decisions?
Yeah, it's a great question. It's going to be twofold. First,
Okay.
I think just being mindful that seasonality, that this where we are in a time cycle can make a difference in terms of our various like our attitudes towards investment, our attitudes preference for risk. I think that makes a difference, period. And so just even understanding that and having the experience and wherewithal to know, okay, where am I? What am I most prone to? What are some general trends that maybe I'm grumpier a little bit on a Monday, or maybe I'm actually more risk averse on earlier in periods and then more risk seeking and risk prone towards the end. I think it's really helpful to understand those things. And the second thing is, well, that could be you have to know yourself and what is it that you can use that strategically. So I know that risk is potentially good, like at the case of my mom. Then maybe book that appointment to talk to an investment a manager or like that wealth advisor. Maybe have that meeting on a Friday, just if you know that your tendency is to be overly risk averse, I'll put it that way, or vice versa, then really stick away from that end of week, end of month, end of year. Otherwise, so just plan accordingly and use it strategically to make the best decisions for yourself.
Ebony, I want to thank you for your time today. It's been a lot of fun.
Thank you so much, John. This was seriously a pleasure, and it's so exciting to talk to someone who has such wisdom in this area too. So thank you.
All the best.
Take care.
John DeGuy is a portfolio manager with Design Securities in Toronto. The views expressed in this programme are not to be construed as specific advice. It is recommended that you consult a qualified advisor before taking action. His books, The Professional Financial Advisor 4, Stand Up to the Financial Services Industry and Bullshift are available through Amazon and in bookstores throughout Canada. You can reach John at 647 Stand Up. That's 647 782 6387 or at jdeguy@designedsecurities.ca.